Hello, everyone. We're going to get started here in a couple minutes, so all the presenters, if you guys could come up stage, and we'll get started in just a minute or two. All right, I hope everybody was able to get some coffee, and welcome back to our second panel. So in this panel, we'll be looking at discrete thresholds in availability of credit, and we have a few really nice empirical papers with applications to the auto lending and mortgage markets. So without further ado, I'll hand it off to our first presenter of the three, Bronson Argyle from Brigham Young University.
Tom, do I have a clicker?
Is that it right there?
I'm not sure. Yeah, perfect. Okay, great. Okay. All right. Thank you so much. First of all, I just want to say thank you for the conference organizers for including this paper on the program. This is joint work with Taylor Nadald, who's also at BYU, and Chris Palmer, who's at Berkeley Haas, who has another paper on the program later as well. So what are we doing in this paper? Well, we are trying to pose and answer two different questions. So the first question is, we want to say something about whether or not individuals are credit constrained, specifically in the market for auto loans. And second, we want to say something about why, I'm going to show you that they are credit constrained. We want to say something about why these credit constraints exist in equilibrium. Now, the extant literature on this has given a couple of explanations for credit constraints. Most of them deal with information asymmetries. So either adverse selection or moral hazard. There's also an explanation based on market segmentation that lending institutions have monopoly power, and this implies credit constraints. And in this paper, we're going to try to present a novel alternative explanation that I think is very intuitive, which is search costs. Search costs of borrowers imply the persistence of credit constraints. Okay, so just by way of motivation, one more slide on this. So Jonathan Zinman, who also has a paper on the program, he said this a few years ago. The continued prevalence of credit constraints is noteworthy and somewhat puzzling in its own right. For all the advances in risk-based pricing, mechanism design, nonlinear contracting, et cetera, prices are still quite far from clearing consumer credit markets. So even though we've made a lot of progress, it's still a puzzle why these credit constraints exist and why they persist in the marketplace. So one quick slide on the data that we're using. We have data from a private software services company. They've provided us with just over 5.5 million data points on auto loans. They originate from over 300 different lending institutions covering all 50 states. Most of these loans originate from credit unions, and most of these loans fall from between 2012 and 2015 inclusively. In addition to this data set, we also have a related data set of application data that deals with details about whether or not a loan is funded, whether or not it's accepted, whether or not it's declined. There's a little bit of overlap between these two data sets, but for the most part, they're distinct. In both of these data sets, we're going to focus on direct loans and only direct loans. So these are loans where an individual went to a financing facility, to a lending institution, and sought financing before they went to a dealership and finalized a car purchase. In terms of the variables that we have, the data set is pretty rich. So we have information on ex-ante borrower characteristics, their demographics. We have data on the collateral of the loan, the terms of the loan, their interest rate, and the maturity. We also have data on the performance of the loan. So the data set is pretty rich. Okay, so in order to say something intelligent about credit constraints, we need to start with a proper counterfactual. So if we go back to our grad school days and remember doing this optimization, we can remember that one of the things that pops out of the first order conditions is the Euler equation. And in order for the Euler equation to hold, it must be the case that an agent has access to a borrowing and saving technology at a break-even interest rate, let's call it R star. Now, within this context, we can think about defining credit constraints in a couple of different ways. One way is to simply say that there is no borrowing. So if we constrict consumption in a given period to be less than income in the same period plus the accumulated assets, i.e. the agent can't borrow at all, that's certainly a credit constrained agent. We could also think about an agent being credit constrained if there's a limit to their borrowing. Yet a third flavor of credit constraints would be a situation in which an agent doesn't have access to this borrowing and saving technology at the interest rate R star. The analogy that we've been able to come up with is this is something like a loan shark. Yes, it's true that an agent may be able to go to a loan shark and borrow, but if they're going to be paying a 4,000% APR, they're effectively credit constrained relative to the market interest rate that they should be paying. So in our data set, what's generating this deviation from the market clearing interest rate? Well, it's going to be a rule of thumb lending rules by the lending institutions. So in talking with the executives at these lending institutions, they told us that they have these rules of thumb based on the FICO score to make decisions about the interest rate. And if you look at this empirically, it's just incredibly stark. So this is an example of, what are we going to do here? We take interest rates and regress them onto a series of dummies that represent 5-point FICO bins. And then we're plotting the coefficients. Effectively, this is a very simple transformation on the average interest rate in a 5-point FICO bin. And what we see are these just incredibly stark discontinuities. So for this given example institution, this is actual data, but it's just been anonymized. This institution clearly has a threshold at 600, this one is 660, and 700. So what does this mean? Well, what it means is that if you're a borrower that has a FICO score of 601, you get a very different interest rate than if you're a borrower that has a FICO score of 599. Even though effectively, from a risk perspective, you're identical, these rules of thumb lead to differences, stark differences in the interest rate that you face. We see this for a number of institutions. The breakpoints are sometimes in different places. Okay, so we want to exploit this discontinuity, and in order to do that, the first thing that we would be concerned about is a violation in parallel trends, that there's some other alternative variable that is also changing across the threshold. So we'll look at our other observables. You may also be concerned that there's a soft information story going on here. So there's some information that we don't observe that's different across the threshold that is going to be driving our results, and I'll speak to that in a second as well. Given that we rule those things out, then we're well positioned to use a regression discontinuity design to say something about how credit constraints affect consumption. There's one more piece that we need to finalize, which is because there are a number of different institutions that have thresholds at different places. One institution may have a threshold at 600, 650, another one may have one at 620 or 640. There's a potential for cross-treatment contamination, where it's not clear whether a borrower is on the left-hand side of the relevant threshold or the right-hand side of the relevant threshold for a different institution. In order to address this concern, there are a number of ways that we could deal with this, but I think the most straightforward way is to simply pare down the number of thresholds that we are going to include in our analysis. We are going to do that in the following way. We're going to limit the number of thresholds to be thresholds that are, first of all, well populated, so thresholds that have at least 100,000 loans within the 19 FICO point on either side, on either side of the threshold, and that they only originate from institutions that don't have another threshold within 19 FICO points on either side of the threshold. This results in three thresholds that we're going to use for our analysis, a threshold at 600, 640, and 700. The results that I'm going to present to you are incredibly robust to this selection. We can look at just 600, just 640, just 700. We can fiddle with these numbers if we want to, and any reasonable specification gives us the same results as those I'm going to present to you. Okay. So given that we've pared down these thresholds, we can then normalize FICO scores. So for a given borrower, we normalize their FICO score relative to the relevant threshold, and then stack all of the loans and run a regression discontinuity analysis. We're going to use the bias-corrected RD estimator that was pioneered by Colonico and co-authors from a few years ago. Okay. So in terms of smoothness, as is typical, no one ever makes the font big enough, so you can't see these, but this is debt to income, loan amount, age, gender, and the number of applications. You can see that these are adequately smooth. There doesn't appear to be a jump across the threshold. We see a spike in the number of applications. This is actually due to the borrowers that have a FICO score of 700. This isn't a violation of parallel trends, because when we look at parallel trends, what we're concerned about is individuals gaming the threshold. If this were the case, then what we would see is a shift in the number of loans across the threshold. Further, it'd be incredibly difficult for a borrower to make their FICO score be exactly 700. So even though we see this spike, it shouldn't concern us. Okay. Now, I said that I was going to talk about soft information. If it's the case that there is soft information that's changing across the threshold that it's going to be driving our results, then it should be the case that that should show up in a difference in ex post outcomes. When we look at ex post outcomes, we see that there's no significant difference in the days delinquency, the charge-off, or the default rates. One of the other things that's really kind of cool about this data is that we have not only the FICO score at origination, but we also have the FICO score from the most recent poll from the lending institution. So we can look at the change in their FICO score between when the loan originated and the most recent FICO poll. If there's a difference in soft information, we would expect that that would show up in a difference in the way that their FICO scores evolve. And we don't see that at all either. Okay, so given this, there doesn't appear to be any sorting across the discontinuities, so this is quasi-random, and we can use this to say something intelligent about credit constraints. If we look at the first stage, we see that individuals to the right of the threshold on average have an interest rate that's 150 basis points lower than those on the left-hand side, and that they get a loan term that's about a month and a half longer than those on the left-hand side. So what do they do with this lower interest rate? Well, they consume more. They consume a $1,000 more car, they get more of a loan, so unsurprising, their loan to value goes up, and their monthly payment increases as well. So it was the case that individuals were credit constrained, because when we relax that constraint, they end up consuming more. We can also say something about their selection. They actually end up buying newer cars, as what they do with that lower interest rate. Now at this point, you may be saying to yourself, well, that's not spectacularly surprising. So you're telling me that when we lower the interest rate and make something cheaper, people buy more of this good. And I would agree with you. I would say that at some level, this is unsurprising, given that people are credit constrained. If you relax that constraint, it's unsurprising that people buy more. What is surprising is that this persists in equilibrium. It's surprising that people on the left-hand side of the threshold don't go find better loans. Theoretically, they're on the left-hand side of one threshold at one institution, but they may be on the right-hand side of a threshold at a different institution. Why does this persist? Well, first of all, let me do a little bit of work to get there. Is it the case that there really is a better loan out there for this borrower? We can test this directly. We take each borrower and we're going to put them into a bin of other borrowers that are very, very similar. So we're going to match borrowers on a number of characteristics. First of all, they have to originate within the same 6-month span. They have to have a car value that's in the same $1,000 bin. They have to be in a FICO score bin that's the same 5-point FICO bin, same 5-point debt to income bin, and the same MSA. I would argue individuals in a bin then, they got loans in the same place, at the same time, for the same loan, at practically the same, with practically the same credit quality. These are very, very similar loans. Given that, we can look within a cell, and for any borrower, we can say, what's the difference between the interest rate you received and the interest rate that you could have received, that was out there, that was available for you? So if we look at kernel density plots of that quantity, the difference from the lowest available rate, this is what they look like. So we see significant mass above zero. There really are loans out there that guys on the left-hand side could have gone and gotten. So why didn't they go get them? Well, we're going to claim that it's search costs. Now, it's difficult to measure search costs, but we can get at it in a couple of different ways. One thing we can do is in the applications data, we can look at the probability that a potential borrower accepts a loan. Whoops, excuse me. So this is simply just a dummy for whether or not the loan that is extended is accepted by the borrower. And we can put that into our regression discontinuity framework. Now, a couple of things that we would expect here. One, we would expect that across the threshold, this coefficient would be positive. Individuals on the right-hand side of the threshold are getting better terms, so they're going to be more likely to accept the loan. Those on the left-hand side are getting unfair or worse terms. They'd be less likely to accept the terms. So we would expect that this coefficient is going to be significantly positive. What's more than this is that if we can split borrowers based on their search costs, we would expect that individuals in areas where the search costs are relatively high would be less likely to walk away from an unfair loan. It's costly for them to go find another loan. If this is the case, then we would expect that they would be less likely to walk away, and this acceptance coefficient, the difference across the threshold would be less for individuals in high search cost areas versus low search cost areas. If it's easy for me to go find another loan, then I'm more likely to walk away if I get a suboptimal rate. Okay, so how do we measure search costs? We've done it a couple of different ways, but and they all qualitatively give us the same results. The one that we like the most is this driving time density. So this is the number of institutions that are within a 20-minute drive of the borrower. This isn't as the crow flies, this is actual driving times. We literally just take a borrower, calculate the number of institutions that are within a 20-minute drive of that borrower. So when we run these regressions, what do we get? Well, we see exactly what we'd expect. This coefficient unconditionally is positive, and we see that in areas with low driving time density, i.e. high search costs, it's expensive for me to go find another loan, the difference in the acceptance rate is less than it is in areas where the search costs are low. High search costs, I'm less likely to walk away from a suboptimal loan or from an unfair loan. Okay, one more slide of results and then I'll wrap up. I said it was difficult to measure search directly, but it's not impossible. Another thing that we can do is we can look at the number of applications per vehicle. So for a given borrower, how many loan applications do they fill out for each vehicle that they're buying? Consistent with the story that we're trying to tell, in areas where the driving time density is high, i.e. the search costs are low, we see that individuals apply for more loans on average, and this difference is statistically significant. The upside of doing it this way is that we don't have to limit ourselves to just institutions that have a threshold, and so we have a lot more observations and a lot more power when we do it this way. Okay, so in conclusion, what have we seen? Well, we've seen that individuals are credit constrained. In the auto loan industry, this is due to arbitrary pricing rules. This distorts consumption, so this has real effects. But what's more than this, I think the bigger contribution of this paper is to say that the reason that these credit constraints persist in equilibrium is because search is costly, and the borrower carries that cost. Thank you.
Thank you, Bronson. So our second presentation will be by Andrew Pachorik from the Federal Reserve Board.
Okay. So thanks very much to the organizers, for inviting us to present. This is, of course, joint work with Steve Laufer, who's also in the audience. The standard Fed disclaimer applies. One way of putting it is that while Steve and I think this is a great paper, Janet and Stan have no particular views on it one way or the other, so far as I am aware. Let's see, there we go. So this paper is all about mortgage credit availability. And if you want to think about how credit availability has evolved since the financial crisis, you can do it sort of according to this heuristic of the 3 C's. C number 1 is capacity. That's the ability of the borrower to repay a loan. You could think about that in most cases as a function of something like the debt-to-income ratio, the fraction of your income that's taken up by debt payments. Now, our take on this is that in this dimension, at least, limits on mortgage credit availability are not particularly tight. There is, of course, the QM rule on back-end DTIs of 43%, but that doesn't actually apply yet anyway to most agency-backed loans or FHA loans. And so if you look in the data, there's lots and lots of high DTI loans being originated. So our view, at least, is that this is not a margin on which credit seems particularly tight. There are exceptions. In particular, it does seem like documentation requirements have certainly become much more restrictive since the crisis. And the story, of course, is that Ben Bernanke, after he left as Fed chair, had a hard time getting a mortgage, in part because he had a hard time documenting all of this newfound income from giving speeches on the circuit and so forth. So the second C is collateral. That's the value of the house. You can think about that as the loan-to-value ratio. Here again, we don't think it's particularly tight. There are lots of low down payment loans being made, and they're available both from the FHA in particular, but also from the GSEs under various programs. So that brings us to the third one, which is sort of credit or creditworthiness itself. And this, in particular, this is captured primarily by credit score. And this is where we think the action is, okay? So it seems like it's very, very difficult now for low FICO borrowers to get loans relative to what it would have been like prior to the crisis. So here's the picture. So these are the cumulative distribution functions of originations by FICO score on the x-axis in 4 years. So the black line at the top is 2005, then the red line is 2008, and then you have 2010 and 2012. So prior to the crisis, and even sort of in the midst of the financial crisis in 2008, there were lots of loans being originated to borrowers with FICO scores under, let's say, 640. Okay, and you can see that just by tracing up from 640 to where the intersection point is with the black and the red lines. Since the crisis really kicked into full gear, and in particular by 2010 and 2012, that part of the market has basically just disappeared, and that's still true today. So by those points, there are essentially no loans being made below sort of the mid 600s. Now, the obvious question to ask here is this supply or is this demand, right? So there's every reason to think that the Great Recession and the financial crisis hit high FICO and low FICO borrowers in different ways through the labor market and in all kinds of other ways. And so you might worry this has nothing to do with credit supply, but it's actually just a demand channel, and that people at the bottom end of the FICO distribution aren't demanding as many loans as they used to. So one easy way to look at this, and this is going to, in some sense, the gist of the identification of our entire paper, is turning from, instead of the CDF, now looking at the PDF, the density function of these mortgages. So what you see here is if you look pre-crisis at 2005 or 2008, depending on how you look at it, there might be some jumps at certain points in the distribution, and there are various reasons for that. But compared to what happened since 2008, if you look at the 2010 or 2012 lines, there things are starkly different, right? There are these huge discontinuities in the distribution of mortgages by FICO score. In 2010, it was at 620, and by 2012, it was up to 640. There's just this big, big jump right at those discrete points. Our view, and the view we're going to take throughout this paper, is that has to be supply, right? There's no conceivable reason why people with a 619 credit score discontinuously demand less mortgage credit than someone with a 620 FICO score. So that has to be coming from the supply side, and that's the gist of our entire identification, is to compare people above and below these thresholds. I'm going to skip the next couple of slides in the interest of time. There's a whole bunch of institutional details in the paper about where we think these thresholds are coming from. They're primarily located in the FHA space, because the FHA was sort of the guarantor of last resort after the crisis hit to these low FICO score borrowers. But it's actually not about the FHA itself imposing these limits, but rather about lenders being unwilling to lend to the full width of the FHA credit box. And so there's a whole bunch of details in the paper, but I'll leave you to review those if you're interested. Suffice to say, these thresholds exist, and they seem quite large to us. So why do we care about this? Tight mortgage credit to at least some borrowers likely could have played a role in at least 3 important outcomes that we've seen since the crisis. One is the huge decline in the home ownership rate and shift toward rental. And in particular, these thresholds are going to be binding on people who really do seem like they're going to be on the margin between home owning and renting. So the aggregate effects, as I'll talk about later on, are not going to be all that large, but they're going to be quite large in this narrow range, and that is exactly the kind of people who you might think about as being on the margin. We've seen a very weak recovery in residential investment since the crisis, and that has been particularly concentrated at the low end of the market. So home builders these days are building far fewer, smaller, and less expensive single-family homes than they used to. Again, that is probably at least partially a function of these kinds of credit constraints at the bottom end of the market. And then finally, when you shut people out of, for all the reasons that people have studied in the past, when you shut people out of home ownership, it's going to have potentially very large negative financial implications for their ability to buffer against shocks and that kind of thing. So there's at least 3 reasons why we think you should care a lot. So what do we actually do in the paper? We're going to use the discontinuities that I showed you earlier in the distribution of credit scores to construct a single measure of mortgage credit availability that captures the effect of these minimum credit score lending rules. We're going to assign this credit availability measure to everybody in the Federal Reserve Bank of New York Equifax Consumer Credit Panel, which is a 5% sample of essentially the entire U.S. population, or at least the entire U.S. population that has a credit record. And in the spirit, it's not exactly a regression discontinuity for reasons I'll talk about in a minute, but in the spirit of sort of a regression discontinuity or difference in difference model, we're going to estimate the consequences of tight credit supply while hopefully controlling for differences in demand that are correlated with the credit score. Because the nonlinearity that those thresholds imply in credit supply means we can hopefully control for demand by controlling for sort of linear effects of credit score directly. So a preview of the findings in case I don't get through it all. We find that the effect of tight credit on mortgage borrowing is very large in the short run. That's not too surprising given the graphs I've already shown you. It is, however, very persistent. The nice part about the panel is we can look over a long period of time. We find very large effects that persist out at least as far as 16 quarters or 4 full years. It does attenuate a little bit, and it does also shrink a little bit somewhat relative to sort of the underlying baseline probability of origination. But the effects are very large and long-lasting is the sort of the quick version of it. We find the effects are concentrated among particular segments of the population that are likely to have credit scores in this region, right? That's going to be relatively young adults, and sort of middle income or moderately black census tracts. And I'll come back and talk about that in a little bit. In the aggregate, we find that the effects are maybe not all that big. We think they lower originations by on the order of about 2% over 4 years, but there are much larger effects, again, close to the thresholds. And then we also go, because there are lots of other outcomes we can look at in the consumer credit panel, we're going to find that having access to credit reduces delinquency on mortgage debt, but also on non-mortgage debt. So that's an interesting finding among people who already had mortgage loans. And we also find effects on auto borrowing. However, we think it has little effect on sort of cross-MSA migration, which allows us to speak a little bit to this sort of question of lock-in and whether or not lack of credit might have prevented people from reallocating themselves across different metro areas in response to the huge sort of location-specific shocks in the Great Recession. So there's several related literatures, which I'm certainly not going to walk through these papers in detail. The key differences, I think, are there's a literature on borrowing constraints and homeownership. We are able to construct our measure for this very large consumer credit panel. We have lots of different outcomes we can look at over a long period of time, and we think we can also control pretty well for demand, which makes a big difference here for the identification. There's several papers that have looked at credit availability since the crisis. The key point here is we're looking at the individual level. Most of these other papers are focused on sort of aggregate on areas, sort of larger areas and the effects on house prices and construction and things like that. There's a literature on the effect on sort of on this lock-in question. Most of those papers are about being underwater in your mortgage, owing more than your home is worth. Ours is about access to credit, so it's a little bit different, but it's at least complementary to that. And then there's a literature about sort of the implications of credit score thresholds before the crisis. The identification here is similar, but we're looking strictly after the crisis, and we think that unlike in that sort of debate, the thresholds since the crisis have been clearly imposed by lenders, and so it's not a question of securitization. And regardless, we're interested in sort of what consumers are doing in response to them. So anything that happens on the supply side of the market is okay from our point of view, because that's fine for identification. So what are we going to do to construct this measure? So first, we're going to have a very simple estimator of the changes in the relevance of the 620 and 640 thresholds. We're going to link those estimates from one data set, the sort of Black Knight loan level data, to another data set, the Equifax New York Fed CCP. And we'll calculate our credit availability measure using the interaction of the thresholds and individual scores to identify credit supply effects. So step one is basically just to measure these thresholds. We do that very simply. We basically just take a ratio of the number of mortgages that are originated just above the threshold to the number just below, and that gets us essentially, that can range from 0 to 1, and that's our measure of sort of the intensity of the threshold at any given point in time. Now, if you'd seen the graphs earlier, you might have thought that this was a very straightforward regression discontinuity application in sort of the same way as the previous paper was. It's not, and that's for a couple reasons. One is that the CCP doesn't have FICO scores in it, and typically most lenders use FICO scores for origination. So we have to do some kind of translation between the two scores. That's sort of a detail. But the other more interesting issue is that the CCP and most credit records more generally are going to be a snapshot on a particular point in time. Okay, so the Equifax CCP in particular is a snapshot on the last day of the quarter. But Black Knight, those data are capturing the scores on the mortgages themselves at origination. And so if you think that credit scores are sufficiently volatile, it's at least conceivably possible that your credit score at a certain point in time, captured at one point during the quarter, is not going to be very relevant for determining if you're going to be able to get a mortgage in the next 90 days, right? It just depends on how variable you think credit scores are. So in some sense, we're going to be testing for that, and our empirics are, in some sense, on the short run, are going to be a test of whether credit scores are, in fact, that volatile or not. Let me jump ahead a little bit. So let's think a little bit about what this would look like with just the 620 threshold, because we're going to have two thresholds we're going to look at in a single measure, but let's just focus on one of them. So we're going to say that you have access to mortgage credit relative to the 620 threshold, let's say, if your score is above the threshold, in which case, of course, it doesn't matter for you, or if the threshold is unimportant at a particular point in time. So, for example, the 620 threshold was unimportant in 2008, as I showed you earlier, but it was important by 2010. So we're going to compute some link function between the probability, the risk score that we observe for you in the CCP, and the probability that your FICO score is going to be above 620. We're going to estimate, as I mentioned earlier, just using a ratio of the counts, the importance of the threshold. And the importance of the threshold is the structural interpretation of that could be it's the fraction of lenders willing to lend below that threshold, the size of those lenders, and in some sense the cost to borrowers of seeking them out. So the sort of the capacity of lenders to lend below that threshold. And so you could imagine doing this if it was just this straightforward, of doing a difference in difference approach where you control for the two main effects, and then the coefficient of the interaction term, that beta in that equation, would be the effective interest. We, in fact, of course, have two thresholds that could be operating simultaneously. So we're going to have two threshold counts, and we're going to construct a single measure of credit availability that's going to basically assign the threshold, those ratios to you, depending on where exactly in the probabilistically, depending on where where you fall in the FICO distribution. So what does it actually look like? So the left picture here is our credit availability measure in the time series. The red line is a version of it that's computed using only the 620 threshold, and you see that falling off very sharply in, let's say, early 2009. The blue line is this version using just the 640 threshold, and you see that falling off very sharply in late 2010, early 2011. So that's the point at which the lenders were sort of imposing these thresholds as their minimum requirements for lending. And then the black line is the measure that takes into account both at once. The right picture here is a different cut through the data. It's cross sections across periods. Okay, so the black line here is 2008. And you can see that by our measure, there is some drop-off in availability as you go from the relatively high FICO people, let's say around 700, down to the relatively low FICO people in our data set around 550. But it's not that big, right? Just a little bit. That becomes enormous by the second period, by the 2009 to 2010 period. And then it gets even a little bit bigger at the bottom, but really becomes bigger in sort of the middle of the distribution as the 640 threshold kicks in. So just a very quick, very simple picture of the data, no controls, no anything. This is the contemporaneous probability of taking out a mortgage in the CCP by your Equifax risk score, okay, over these three relatively stable periods in which there weren't any big changes in availability going on. So during the first period, where there were no thresholds, you see sort of this relatively smooth pattern, this black line. During the second period, once the 620 threshold had kicked in, there's a huge decline in relative terms in originations at the bottom end of the credit score distribution. And as the 640 threshold kicks in, you see a big drop off farther up in the distribution. Okay, so in some sense, just in the most simple way, simple cut through the data, you can sort of see these effects without any fancy controls or anything else. So the empirical specification is going to be our credit availability measure, obviously, with the coefficient of interest being beta. We're going to control for the main effects of the probability of being over the thresholds. We're going to control linearly for risk score and interact that with a time fixed effect, right? So that delta t varies by time. So we don't just pick up the linear effect of credit score, we pick it up varying over time. And that's because we have our credit availability measure being nonlinear and varying over time. So we can take out a lot of that variation. And we're also going to control directly for time fixed effects and control for lags of a lot of these measures, because we want to capture credit availability at a particular point in time, controlling for a lot of these things, especially credit availability, say 1 period earlier. We'll use a variety of models depending on the outcome, and we're going to estimate each model both on the full sample and then separately based on those who do and do not already have a mortgage. The key point here is that we're going to be we're secure against confounding factors that either vary only in the time series but affect everyone, that vary over time and are correlated with the credit score in a linear fashion, and that's where we think we really are taking care of most of the demand effects, or are correlated with the nonlinear threshold probabilities, but don't vary over time. So I'm actually going to skip the tables, because frankly I can tell you what's going on in these tables much more easily than I can walk you through the numbers. Obviously they're all in the paper if you want to take a look. So we find that the credit score thresholds have very large effects on mortgage borrowing at short horizons. That's a fairly straightforward, but it's not completely trivial, because again, if you had credit scores being very, very variable over short periods, it's not obvious that the thresholds that we observe in the loan level data have to show up in the credit panel. The effects attenuate only slightly over 20 quarters, although they shrink more substantially relative to average probabilities of mortgage attainment. We find that access to credit substantially lowers the probability of mortgage default among prior borrowers. And prior borrowers do not seem to be locked in. That is, if anything, lack of credit increases their moving across houses and has no effect on their cross MSA migration. And then finally, we do also find effects on auto borrowing. We find that prior borrowers buy more cars when they have access to credit, which points to the importance of refinancing. And that prior non-borrowers, which loosely speaking is non-homeowners, buy fewer cars, which suggests there's some substitution between buying a home and buying a car. Heterogeneity, I'm going to have to skip through this pretty quickly. It's all in the paper. The one key point I want to make is there's two ways in which these effects could be heterogeneous across different groups. It could be that the credit availability measure drops by more or less, depending on how credit scores vary with these different age or income groups. But it could also be that the effect of credit matters more for different groups, right? So for example, just looking at this income picture, the lowest income people have low FICO scores, so they're more likely to find that the credit availability measure that drops by more for those people, but the effect is actually smaller because low-income people are less likely to buy a home in the first place, right? So in the end, we find actually that the largest effects are for these middle groups, sort of the 30 to 40 to 50-year-olds, and certainly not the older groups, because the drop from the black to the red to the blue line is larger in the middle of the distribution, and it's larger for these sort of middle income groups. We do a counterfactual exercise. The decline in originations overall is not all that big. It's probably on the order of 2% over a full 4-year period, but it's much larger in this narrow region around the thresholds. And that, again, is probably an area in which you'd expect people to really be on the margin between renting and homeowning. So I think I can just leave it there. I think the main point for us is that we find these very large effects in a short run that are quite persistent over time. And so it's just another way in which policymakers who are thinking about this have to sort of balance the obvious need to protect the financial system against waves of mortgage default, but also sort of protect access to credit, because it has all of these additional implications that are very, very persistent over time. Thanks.
Thank you, Andrew. And so our third presenter in this panel will be Anthony DeFusco from Northwestern University.
I don't know. Okay, good. Just checking how sensitive this is. All right, so this is going to be joint work with Stephanie Johnson, who is a graduate student at Northwestern, and John Mondragon, who is my co-author there. So the title of the paper is Regulating Household Leverage, from which you can probably guess that the motivating figure is going to look something like this one, which is just showing time series patterns in the ratio of total outstanding household debt to disposable personal income since 1990 in the US. Okay, so as we all know, there was an enormous fluctuation in household leverage surrounding the Great Recession. And there's a significant amount of evidence, both empirical and theoretical, suggesting that this wasn't a sideshow. We think the increase in household leverage during the run-up played a non-trivial role in sort of facilitating the run-up in house prices that eventually led to the recession. And we think that the level of debt that was outstanding at the time the recession hit was important for determining both the severity and magnitude of that recession. This is something that policymakers were not unaware of at the time, and policy kind of responded along two dimensions. The first was an immediate set of ex post policies intended to mop up the immediate aftermath of the crisis, largely centered around renegotiation of household debt or aiding households with their to make their mortgage payments. A second set of policies was more forward-looking and sought to reduce the likelihood of debt-driven or sort of debt-magnified financial crises going forward, and this was motivated from two perspectives, one being sort of a systemic risk macroprudential perspective, and the second being more at the individual level consumer protection motivation. There's a large amount of work on that first set of policies. I think about HAMP and HARP and everything we've learned about that. There's relatively little empirical evidence on the second set of policies outside of things like the credit card market, looking at the Card Act, et cetera. So this paper is going to come in and try to look at an example of one of those second types of policies. We're going to be trying to use loan level data to study the impact of an important US policy that was passed in direct response to the financial crisis and was intended to reduce household leverage in the mortgage market. So the name of the policy we're going to study, which I'll talk about in a second, is called the Ability to Repay in Qualified Mortgage Rule, which broadly speaking, you can think of that as it's a Dodd-Frank rule that made it more costly for banks to originate high leverage mortgage loans. The questions we're going to ask are, what were the effect of this policy on the price of credit? Did it raise the price that borrowers pay for high leverage loans? How did it affect the quantity of credit? Are there loans that were not made as a result of this policy that otherwise would have been? And conditional on a loan being made, how much lower is the borrower's, the measure of leverage we're going to be looking at is debt to income relative to what it otherwise would have been. And then finally, we're going to not speculate, but do back of the envelope calculations on what the implications of this policy might have been for mortgage market performance had it been in place during the run-up to the crisis. Bottom line conclusions from this, which I'm going to say in words now and in numbers later, is we're going to find that the policy has sharp but modest effect on prices, what we think of as being a sizable effect on quantities, and minimal implications for mortgage market performance. I just noticed this is 31 slides. My deck was actually 27, so I'll figure out which slides to drop as I go through. Okay, so I'm going to go through a little bit of overhead. For those of you at the CFPB, trigger warning, this is going to be both boring and frustrating to you, given the lack of precision in my language. So the name of the policy we're studying is the Ability to Repay in Qualified Mortgage Rule. This was mandated by Dodd-Frank and implemented by the CFPB. It's a regulation basically requiring that lenders not make loans unless they make a reasonable good faith determination that a borrower is going to be able to repay that loan. The policy had these two sources of motivation, macroprudential and consumer protection. It was passed in January of 2013 and implemented in January of 2014. So how do lenders comply with this policy? There's essentially two ways that the law lays out to comply. One is to make a reasonable good faith evaluation of the borrower's ability to repay, and the law stipulates 8 criteria that the lender has to consider in making that determination. However, there's no explicit guidelines on what consideration means or how those 8 factors should be considered in the decision whether or not to extend a loan. There's also, in the general way of complying with this law, no explicit requirements on what the product features have to look like, no limits on the type of loan that's being made. That's a very fuzzy way to comply. There's a very fuzzy definition that's difficult to figure out whether or not an individual loan is in compliance or not. So the law laid out a second way to comply, which is to originate a loan, which is referred to as a qualified mortgage. That's a loan whose characteristics satisfy a given set of terms set out by the CFPB. And if you originate a loan that's a qualified mortgage, you are in many ways presumed to be in compliance with this law. So that's kind of the primary or most clear-cut way to comply with this requirement. What does compliance buy you? It buys you protection from legal liability in the event that a borrower files a lawsuit against you under this ability to repay requirement. And originating a QM loan is one particularly easy way to get that protection. So what is a QM loan then? What are these product characteristics that your loan has to have in order to be qualified or to consider a qualified loan? So it can't be an exotic mortgage of the type that essentially doesn't exist now. It can't be interest only, balloon, or negatively amortizing. It has to have standard term of less than or equal to 30 years. Points and fees are capped at 3%, and the lender has to verify the borrower's income, assets, and debt. The most important sort of characteristic for what we're going to be doing is that if a loan is going to be a qualified mortgage, it also has to have a debt-to-income ratio below 43%. However, at the time that the law was put into effect, there were concerns that this debt-to-income requirement would be restrictive and might lead to curtailment of mortgage supply. So a very large portion of the market was exempted from that 43% requirement through what's colloquially referred to as the QM patch. What this means now is essentially all loans that are eligible to be purchased by the GSEs, Fannie or Freddie, or FHA loans are not required to meet this 43% requirement in order to be considered qualified mortgages, which at the end of the day, for most intents and purposes, means that a non-QM loan is a jumbo loan with a DTI above 43%. Everything else is QM, conditional on it satisfying these other requirements. Okay, so we're going to be looking at high DTI relative to low DTI jumbo loans, before and after the policy, also relative to conforming loans. And we're going to again be asking these three questions. How did the policy affect the price, quantity, and anticipated performance of mortgage credit? To do that, we're going to be using standard mortgage performance data from CoreLogic, looking at a sample of loans, vanilla purchase mortgage loans originated between 2010 and 2015. Okay. So we have these three questions. We're going to start with looking at prices. Did this policy lead to an increase in prices for non-QM loans relative to QM loans after its passage? Our approach to answering this question is going to be in diff and diff, which is motivated by this figure. This is just showing the raw average interest rates on jumbo loans by the month of origination for high DTI jumbo loans, which is the orange line, and low DTI jumbo loans, which is the blue line. Okay, and you see up until January 2014, when this law was put into effect, interest rates on those two types of loans tracked each other pretty much in lockstep, and then there's this divergence only for the high DTI loans starting in 2014. So that motivates our approach, which is a basic diff and diff comparing high relative to low DTI jumbo loans before and after the implementation of the policy. I won't show it to you here, but this is also robust to a triple difference where we also use conforming loans for which the DTI doesn't matter as an additional control group. Bottom line from the analysis is summarized in this figure, or this table. The second row is the relevant one that's showing the diff and diff estimates of the effect of the policy on interest rates for non-QM loans. We find across a range of different specifications an increase in interest rates somewhere between 10 to 15 basis points. Okay? So that's the sense in which we think this is a somewhat modest effect on prices. That effect shows up at a DTI of exactly 43%, and it's just a level shift at 43%, suggesting that this isn't coming from borrower selection. It seems to be equally applied at all DTIs above 43%. Okay, so we think this is a modest effect. It's sharp but modest in the sense that if you held this loan for 30 years, it would imply an increase in interest expenses of about $13,000 to $20,000. If you refinanced after 5 years, that would go down to about $1,700 to $2,600. The second question we want to look at is how did this affect the quantity of credit? And we're going to be looking at two margins here. The intensive margin, which is shifts from high DTIs to lower DTIs, and the extensive margin, which is are there loans not being made that otherwise would have been. To do this, we're going to be looking at a bunch of distributions, which are going to look somewhat like the following. So let me walk through this picture. So this is showing the distribution of debt to income for jumbo loans originated in 2013. That's the year before the law went into effect. Each dot is just the fraction of loans in a given 1% DTI bin, and that vertical line is the 43% threshold. There's a large drop at 45, reflecting the fact that a lot of lenders impose their own DTI requirements at 45%. If you move forward to 2014, you see that there's a significant amount of bunching right at the 43% threshold, and what looks like a decent amount of missing mass at DTIs above that threshold. This is how we're going to measure the effect of the policy on the quantity of credit, basically comparing the orange line to the blue line in that region. However, we need a better estimate of the counterfactual than just the blue line, and we have an approach to getting that, which is going to construct that counterfactual using changes that happen in the DTI distribution in the conforming market under the assumption that year-to-year changes in that distribution in the conforming market can serve as a reasonable proxy for what would have happened in the jumbo market. There's a series of assumptions we have to make in order for that assumption in order for this to provide a valid estimate of the counterfactual. I'm not going to go through those assumptions now. The important question is whether or not this works, and the answer to that is going to be yes. So how are we going to figure that out? We're going to look in pre-policy cohorts of loans and ask, does the approach that we use to estimate the counterfactual successfully replicate the distribution of DTIs, which it should in those years because there was no policy change. This is that picture in 2013. Orange is data, and blue is our estimate of the counterfactual. It seems like it does a good job. Another way to do this is to look at all consecutive pairs of years prior to when this law was passed and just calculate the percent difference between each blue dot and each orange dot and plot the distribution of those differences. That should be centered around 0 and fairly tightly distributed if this is a good approach to getting the counterfactual, and that seems to be the case here. So we think we have an approach to estimating the counterfactual in hand, which we're then going to use to estimate the effects of this policy on the quantity of mortgage credit. So this is what you get when you do this in the actual year that the policy was passed. The orange line is data. I already showed you that. It's the DTI distribution in 2014 among jumbo loans. The blue line is our estimate of the counterfactual. If you compare the orange line to the blue line, just at and below 43%, it suggests that about 2.7% of the entire jumbo market was shifted from DTIs above 43% to DTIs just below 43%. If you compare the amount of missing mass to the right, which is the number of loans that disappeared from the right, relative to the number of loans that were shifted just to the left, the difference between those two things gives you the number of loans that completely disappeared from the market. We estimate that was about 2% of the entire jumbo market disappeared as a result of this. That's robust to a bunch of different assumptions about where you draw those lines, the lower limit. Bottom line conclusion is what we think of as being sizable effects. 2% of the entire market disappears, about 3% of it is shifted from higher to lower DTIs. The last question we have is how can we think about the possible effects of this policy on mortgage market performance? And to do that, we're going to conduct a thought experiment where we say, what if this policy was in place in its fullest possible implementation during the run-up to the financial crisis? Okay? So we're going to take our estimates of how the policy affected the DTI distribution, extrapolate those to pre-crisis cohorts of loans, and say that if this policy was in effect in 2007, 2% of the market would have disappeared, 3% of it would have shifted from above to at 43. Put that aside, and then we're going to now go to those pre-crisis cohorts of loans and ask what was the relationship between DTI and default in those cohorts, and say, given that relationship, if we shifted the DTIs around in the way that our quantity estimates suggest that it would have been, what's a back-of-the-envelope guess for what would have happened to mortgage market performance? So just before doing that calculation, just to give a rough sense of what that relationship between DTI and default looks like, I'm going to show you two pictures. This is the jumbo market. This is pooling all loans in the jumbo market originated between 2005 and 2008, plotting non-parametric estimates of the relationship between DTI and default. What you see is an interesting fact, which is that at high DTIs, where this law applies in the jumbo market, there's essentially no relationship between DTI and default, suggesting that if you moved loans from above 43% to just below 43% in the jumbo market, it would have no effect on their predicted probability of default. This law is slated to expand from just the jumbo market to the conforming market when the GSEs exit conservatorship, or in 2021, right now. So if you were to expand this to the entire market and ask it its fullest possible implementation, what's the hope for this in affecting default rates? There you might get some bite. This is showing that same relationship for the entire market. It looks to be upward sloping at all DTIs. So now we can think about quantifying the effect of the policy in that counterfactual largest possible implementation on the aggregate default rate. So to do that, we're going to take those 2005 to 2008 loan cohorts and group their DTIs in 3 bins that are consistent with the approach we use to estimate those quantity effects. We're going to have a high DTI bin, which is all DTIs above 43. We're going to have a medium DTI bin, which is between 38 and 43. That's the region of the distribution to which we think this policy shifts loans. And then we're going to have a low DTI bin of DTIs less than 38. That's the region of the distribution that we're basically assuming the policy is going to have no effect on. And then we're going to use those bins and run regressions of 1 to 5 year default rates, cohort by cohort, where we just regress whether or not the loan defaulted on those 2 bins and get the coefficients from those regressions. Those 2 beta coefficients are going to tell us the relative default probabilities. In particular, beta H there is going to measure our estimate of how much you would reduce the predicted default probability for a given loan if you were to shift it from above 43 to just below 43. Using those beta coefficients and those quantity estimates I had from before, we can construct a back-of-the-envelope estimate of what this would imply for the aggregate default rate and show that cohort by cohort. So that's what this figure is showing, those 4 cohorts of loans. If you just look in the top left, that's the 2005 cohort. and look at the farthest right dot there, that's the 5-year default rate. What that dot says is that the predicted effect of this policy on the aggregate default rate for the 2005 cohort of loans would have been to reduce that default rate by 0.1 percentage point relative to what it otherwise would have been, which is an extremely small effect. If instead you were to look at the bottom right corner, which is the 2008 cohort, the cohort that in our sample performed worse, the effect goes up a little bit, but it's still a reduction in the aggregate default rate by about 0.2 percentage points. Which, if you take into account the fact that that cohort of loans had had default rates in the double digits, somewhere between 15 to 25%, that suggests what we're calling minimal effects on performance. Okay, so that's the bottom line conclusion. Again, we find that the law had sharp effects, but moderate effects on prices, what we think of as being fairly sizable effects on quantity, but only minimal implications for mortgage market performance, which taken together you can think of as suggesting that regulating household leverage in this way is costly if you think of these price and quantity effects as costs and the performance improvements as benefits. We're looking into decomposing this DTI shift in a couple of ways. We want to see are these shifts in DTI actually coming through actual reductions in loan size, or is it just lenders working harder to document other sources of income that they otherwise wouldn't have been able to do? We don't have that yet, but we're going to try to do that using changes in the actual payment size of these loans. And the other thing we want to do is see which lenders are responding. Where is that price premium coming from? Is it a market competition effect where some lenders are dropping out of the market, leaving market power remaining for the other lenders? Or are some lenders charging premiums and others not? We think that's going to be important for thinking about the effects of this policy if it were extended beyond just the jumbo market. But for today, that's what I've got.
Thank you, Anthony. So next we'll have remarks from our discussant, Paul Kalem of the Federal Reserve Bank of Philadelphia, after which point we'll open it up to questions from the audience.
Okay, so I'm happy to be here to discuss these 3 very interesting papers. I guess I changed it before my disclaimer, but you actually have a longer disclaimer, one for the Federal Reserve System. The views are my own, not those of the Federal Reserve System. I'm also a couple days a week visiting scholar at the CFPB. I think that's my title. I'm not quite sure, but on the ID it says detailee, but I don't know if that's what. I don't want to be known as a detailee, especially in this context. So I'm my views also. These are my views and not those of the CFPB. So these are very interesting papers that look at an interesting phenomenon in especially in consumer credit markets, which are these credit thresholds. We've seen 2 of the papers talk about credit score thresholds, one in mortgage lending and one in auto lending. And the third paper is talking about the DTI threshold that is part of the ATR-QM rule that was implemented in January 2014. First paper looks at the impact of credit score thresholds on mortgage origination and some other credit-related outcomes. The second paper looking at the thresholds in auto on impacts on loan terms and again other related outcomes, and takes it one step further and discusses the role of borrower search costs in the context of markets where these thresholds are in place. As we've just seen, the last paper is the impact of the DTI threshold on pricing and availability of jumbo mortgages. So all 3 papers, I think, highlight significant credit availability and pricing impacts of the thresholds. And I think they're all definitely worthwhile contributions in that respect. They very carefully document important impacts in the data on credit availability. The paper on mortgages shows a discontinuous drop in mortgage originations as FICO scores fall below these 2 thresholds at 620 and 640 that were associated with credit tightening by FHA lenders during 2010. initially to 640 and then to 620. We also see carefully demonstrated, documented, and shown discrete increase in the average auto loan interest rate and decline in the term to maturity at FICO thresholds applied by credit union lenders. And these are, the development of this analysis is fairly, is very careful and detailed, but essentially they end up looking at representative values for these thresholds of 600, 640, and 700, but they demonstrate that these thresholds vary by institution, which is part of the search cost hypothesis. We also see the decrease in the value of the purchased auto as you go below the threshold, but the LTV, the loan amounts also decline. So you see both declining, and LTVs are not so much affected. And then the last paper showed the interest rate premium on jumbo mortgages to borrowers with the greater than 43% DTI. There's interest rate premium is implemented, and we also see a drop in, and I think this is an important point, drop in the paper is looking at fixed rate mortgages. So we see a drop in fixed rate mortgage originators in this case, to those exceeding the thresholds. And another important point is the data is data reported by large servicers. So we see a drop in FRM originations as reported by large servicers. Okay, so all three papers, because they highlight these effects, I think are important contributions. And there's other findings, particularly in the one on mortgage credit availability. Also, very interestingly, shows that the score thresholds are also associated with reduced auto loan availability, the mortgage credit thresholds, and reduced mobility of households. So it could be that they're just picking up the similar thresholds, acting both in mortgage and auto, but the authors also have some other explanations for the association with auto as well. And finally, as I said, the impacts of the auto lending thresholds are shown to be exacerbated in markets that, according to their measures, have larger search costs for borrowers. Now, each of these papers are distinguished by specific, those are the broad similarities. Obviously, they also have very specific goals and challenges in the data that are specific to each paper. And I think the way I look at the mortgage threshold paper is that I think the question they're trying to answer is, they clearly document that these thresholds effects are there in the mortgage data itself, the mortgage servicing data. They want to, the challenge for them is to extrapolate these observations on FICO score thresholds, the drop-off in loan originations that are pretty sharp, as you've seen. They want to extrapolate that to the general population in Equifax data, okay, in credit bureau data. So the issue in the DTI study, which is we're only looking at servicing data, to their credit, they're trying to get beyond that and extrapolate. I'm sorry, the DTI study is looking at large servicers. They're trying to extrapolate beyond that to the whole population. So I think that's to their credit. But it's challenging. And one challenge is that in the mortgage data, you have a FICO score. In the credit bureau data, you have a risk score, and they're not a one-to-one correspondence. Someone with a given FICO score might have a range of Equifax risk scores. So that creates a challenge for them. One other advantage, as you've seen in the paper, of mapping from the servicing data to the credit bureau data is you can try to draw more conclusions about geography, about borrower age, about their mobility, and all these are very interesting applications that they're trying to do in the paper. And again, the auto paper is trying to move beyond just the threshold impact and discuss search costs. their challenge, of course, is relating these threshold effects to search propensity and search cost. That's their challenge. And then the ATR QM DTI threshold paper, I think, and I think their big challenge, I think, which they need to look into is what the first paper tried to accomplish, getting their analysis to be, somehow representative of the entire market. Okay, right now it's just large servicers, fixed rate mortgages. All three papers, I think have a common challenge, a common impediment that they just, to some degree attempt to overcome. But it's very difficult, and that's this impact of borrower self-selection at the thresholds. Now, in terms of FICO thresholds, I think, in fact, this is an essential part of the auto paper. If they point out that better options may be available to those who seek them. Now, I think FICO thresholds are nice that it's not that easy to game them. I mean, there's been some talk about people gaming them, but it's not that easy. But if different options are available at different lenders, different thresholds, then you can see more sophisticated borrowers doing the search or realizing that there may be better options out there, and this can create a threshold effect at a given lender. They're self-selecting to the better options. So that could lead to a biased assessment of the impact of these thresholds, I think, when you're looking at institution-specific effects. In the mortgage paper, at least in the servicer database, and they're trying to get around this by going to the Equifax data, you could have self-selection out of that servicer data to regional community banks or non-banks that are external to that database, okay? And similarly in the DTI paper. So they have, so that's in the background, makes it a more difficult problem than maybe these papers recognize, and they need to give that some thought. Now I'm a little, I found it hard to understand the empirical approach in the paper on mortgage FICO thresholds. It's meant to be sort of a regression discontinuity approach. So they have this affordability measure, which was discussed, which it tries to say, if you have a given risk score, what's your probability of having a certain FICO score, and tries to do that mapping, and then it multiplies that probability times the observed impact of a threshold in the servicing data. I have trouble understanding that, and the regression discontinuity assumes that within this range around a given threshold, you have a linear relationship, I believe, to the Equifax risk score, but you have this very nonlinear relationship to the threshold. Why one linear, why the other not linear? Why you could just as easily be reversed. I don't know. It could be linear in probability and nonlinear in the risk score, which is supposed to control for all the other factors. So I find it confusing. I would actually find it more transparent and intuitive maybe to just define a risk score range where you see the discontinuity should be, let's carve out a range where you have a high probability of being at that FICO threshold and look above and below that range and see if you see this big drop and measure it that way. And then you could validate otherwise the relationship to risk score seems fairly linear, and then you could just assume it's linear through that range where you're assuming the threshold occurs. So I think there's a more transparent way to do this. I found it confusing. The affordability measure implicitly assumes the impact of the threshold doesn't vary with distance from the threshold. That's again, it's all about probability of having a certain risk score. So it's not about, it's not about multiplying a conditional probability times times a conditional value. Okay, so anyway, I'm running out of time. I want to finish up here. The ARM mortgages, the large servicers, that's the main problem issue that needs to be discussed in the ATR QM paper. I think, I don't know, where's the other paper? I think The price dispersion paper, I think, needs to, I'm not saying it needs to, but at least recognize the limitation here, which is you're not really directly demonstrating a link between search costs and threshold impacts. It's more indirect. And one thing I'm left wondering is, in order to focus in on the 600, 640, 700, an argument is made that these are the most predominant or prevailing thresholds. Well, if that's the case, then how much price dispersion do we really have? So I think there needs to be more exploration in actual credit bureau data of how much price dispersion there is. Let's discuss that first. Let's get some sense of that first. And is there enough to really pursue this search cost, argument? There's also alternatives to search cost explanation. As I said, borrower financial sophistication that's causing these, at least maybe not the entire threshold effect, but contributing to it. And some kind of statistical discrimination, or as he discussed in the paper, an adverse selection type effect. There's an old paper of mine that talks about statistical discrimination. I don't think you've really done, you show that just above and below the thresholds, there's not that much difference in delinquency ex post, but I'm not sure that's sufficient, to dispel the statistical the discrimination story or adverse selection story. We can talk about that offline later. So in summary, each of these studies contributes significantly to our understanding of the use of these risk measurement thresholds in the lending decisions and the impacts. But I think each of the papers could benefit from increased attention to their limitations, whether actually doing more empirical work, or at least acknowledging some of the limitations and discussing them. So, thank you.
All right, thank you for the discussion, Paul. So at this point, we have hopefully about 10 minutes left still to open it up to the crowd for questions. Got one in front here.
Anthony, is it possible that another benefit of the QM rule is that it improves the loan, has an impact on loan to value, and that we take that into account in estimating the impacts of it on default? And Bronson, are you implicitly assuming that there are no fair lending problems when you come up with available loans? Do you do a matching that imputes rates as well to see what's available, what are the APRs available? Yeah, so that's an interesting question. I think it's in our counterfactual exercise that it would boil down to saying sort of shifting people not just along the DTI distribution, but also possibly along the LTV distribution. We haven't done that exercise, but it's something possibly worth doing. I don't know that it would move the default rate that much, but that's an empirical question. We should check it out.
And we haven't looked directly at any kind of violation in fair lending. So what exactly do you have in mind?
Well, when you're looking to say you match two borrowers that
Yeah.
in the same, you don't match on rates, and it's possible that the systematically minority borrowers are are not the lowest ones, and that you're you're misestimating what was really available to minority borrowers.
Okay, I think that's reasonable to look at. It would be interesting then to just like add to that restriction in the construction of the cell some kind of demographics as well. Right? It's a great idea.
I see a question on the far end over there.
Hi, Scott Fulford, CFPB. So this is primarily for the first two papers. So both papers are using a threshold imposed by lenders to understand consumer behavior. I was hoping you'd give us a little insight into why lenders are behaving in apparently non-profit maximizing ways, because that's how you're getting your identification, and in some ways it's the big puzzle. Why would they treat left-hand side and right-hand side, which should be almost identically, very, very different?
I think this is a really reasonable question, and it's one that we put to executives at these lending institutions. And I think the story that we got back from them was that it was just really, really costly for them to have to analyze every single loan. And given that they're essentially hiring lower level employees to make these decisions about loans, they need to provide some very kind of simple back of the envelope rules for loan officers to make those decisions. And so that's the explanation that they gave us for why they're using these kinds of thresholds. So I don't know if Andrew,
That's better than I could have put it.
All right, we have another one on that side of the room.
Yeah, hi, this is Aaron Schroeder, CFPB. My question is for Bronson about the auto paper. So one thing I noticed is that you guys are very focused on direct lending, but in the auto loan world, right, like I would say a conservative estimate is that 80% of loans are indirect, and so when I think about what is the context of direct loans, I think of two things. It's either one, this world of private transactions, right, where this is going to be a data set that's really focused on people who are buying cars outside of the dealer world, and I kind of wonder about what the impacts of that are kind of on the wider world. Or it's a world in which there's this kind of selection on people who are taking out a direct loan when they were probably offered something at the dealership. And so then I start to think about, what does that mean about heterogeneity in FICO score? Because, for example, you're going to see more offers coming to someone with a 700 score versus a 640 score versus a 600 score. So without answering any of those questions and leaving them to you, I just kind of
No, absolutely. I think that's a really great insight. It's something that we've actually thought a lot about. So our original concern with, a couple of things. So at least in our data set, which appears reasonably representative when you look at summary stats, the majority are actually not indirect loans. So that may be surprising or not. But the majority are direct loans. I think
that's the point of the question.
Well, can I?
The majority of loans are indirect, but your loans are direct. So kind of what is the impact of that on your result?
I see. I think the concern that we had is that including indirect loans allows for this added potential bias of a dealership having maybe a kickback relationship with a lending institution, and so in order to focus on borrowers shopping for financing first and to exclude this kind of kickback bias, we wanted to focus on direct loans. But I think the question that you bring up is a really good one that we should think more about. That is there potentially something going on that is driving this difference between direct loans and indirect loans?
Can I mention that too? Because I actually want to defend them on that one. So I think
I'll take defense.
They actually point out in their paper that they're limited to a credit union sample, and they kind of say it like kind of in a apologetic way, and which is okay. But I think they're maybe a little too apologetic, and it's the same idea. Direct loans at credit unions. On the one hand, sure, there's some selection into that sample, and that may be not a good thing because you can't extrapolate outside to the whole population. But on the other hand, it makes for a much more homogeneous population that actually would be the population that would go and shop around at other credit unions and other banks. So I think the trade-off is between some kind of selection effect of this population versus having a much cleaner laboratory that's actually a laboratory where his measure of search costs actually means something.
I certainly would agree with that. And I also think, again, looking at the summary stats, the loans that we are looking at appear to be very representative. If you compare them to census data, limiting yourself to just direct loans, it still appears that you have a reasonable external validity.
Hi, I just had a quick question about the credit union data. So for credit unions, there's typically membership constraints. How do you control for, you can't directly substitute if you don't have that employer or whatever.
Absolutely. This is fantastic. So this is one of the things that we were worried about as well, that maybe what's going on here is that, it's that that best available loan is for a credit union that's only for firefighters. And so, well, I guess that's a really high search cost, right? You got to go train and become a firefighter if you want this loan. What we did to address this is we limited the sample to only credit unions, where we actually looked up their membership requirements. And we limit it to only credit unions where their membership requirements are location-based. So if you live in that area, which is already true because if you're in that cell, you are in the same MSA, then you could have joined that credit union trivially. You qualify. So this is it's a great point, but we looked at it.
Sharon O'Donnell, Census Bureau. Thank you for asking my first question. My second question is to Andrew, and it has to do with location. And by location, I mean not just any location, but locations that varied in terms of the presence of housing bubbles during the financial crisis. So you have places like the 4 states that make up the Sand State where they went through this great rise and fall, particularly in this time period. And then you have other areas like Austin, Texas, Indianapolis, that just had a steady increase in home prices over this time. So my question is, does location matter in your model?
So in the way we compute the credit availability measure, it's basically not going to matter, except to the extent that credit scores might systematically differ across areas, but that's not really true. And the reason for that is just that you saw the starkness of the thresholds. They're basically nationwide, and they came in very starkly, within a couple of quarters across the entire country. So the measure itself is not going to vary across space. What does vary across space potentially is the effect of the measure, right? So just as I showed that the effect differs across income groups or across age groups, and in fact, the income we're imputing based on your location. So for sure, it matters. Location matters in that sense, but it could matter in lots of other ways. We haven't done anything like looking at the differences in the effect of changes in credit availability across different MSAs, but that's a really good idea.
I think I saw we had one more, maybe 2 more questions we have time for. We only have 1 minute left, but yeah, please go ahead.
Concerning the third study, I'm wondering, have you considered the effect of missing income? For example, if, say, someone is fresh out of law school, has very little income, but the banker knows this and perhaps makes a loan anyway. Or alternately, if you have a cosigner for these loans, do you have that data? Because it strikes me that might account for the plateauing beyond 43% that you see.
Yeah. Turn it off. So the measure of DTI we have does not document the sources or even kind of level of income. It's a back-end DTI that includes all of the other debt payments, which we don't know. So it's difficult to know exactly where the income is coming from. I don't think differentially that would matter at 43 in terms of what we're measuring, these shifts to exactly 43. One thing we are thinking about, which I kind of addressed at the very end, is are lenders looking to find other sources of income that they weren't looking for before? And is that why you see part of the shift to 43? We're looking into that, and we think we're going to be able to address it just by looking at what happens to the payment sizes around that, and the LTVs around that threshold.
All right, I think we've got one final question up.
So I had a question about the ATRQM2. This is Avon Pal, CFPB. So it seems like several ways the analysis is sort of stacked against the ATRQM rule. One is sort of not talking about shifts in the LTV distribution. The other one is sort of, from what I understood, making the assumption that the 2013 to 14 change can be sort of directly applied to what was going on in 2018. Another one is that sort of an other possible explanation for the leveling off is because we know that income wasn't verified. So if you have a very noisy measure of income, you don't actually expect DTI to be predictive of pretty much anything. So it's kind of baked into the analysis. And then also, I mean, it's a basic requirement that income and debt analysis be documented is there in the ATRQM rule, and probably that by itself would have helped a lot in, during the run-up in the housing bubble.
Yeah, so I think that can be parsed kind of into 2 things, right? One is it correct to extrapolate our 2% and 3% numbers to pre-crisis cohorts of loans? And then the other is conditional on that being correct is the slope that we're estimating, the right slope going forward. So on the first part, I don't know. We can do a bounding exercise where instead of assuming it's 2% or 3%, we assume it's 100% of the DTI, high DTI jumbos or high DTI loans disappeared, and calculate the aggregate default rate under that. Counterfactual, there we don't get to use our quantity estimates, but the effects on default are still going to be quite small just because it's a relatively small fraction of the market in general. On whether or not the slope is correct, I think that's related to this LTV point, is that can we just kind of take that conditional on LTV slope as being the right way to think about shifting people around that? I think we have to think a little bit harder about. We're not going to be able to nail it on this extrapolation part about where we're kind of extrapolating to these performance results. There we could do a similar bounding exercise and say how steep would the slope have to be in order for this to generate something that might even look like a percentage point change in the default rate for those cohorts. And I think it's going to have to be pretty steep.
All right, unfortunately, I think we're out of time, but hopefully we can give one more round of applause for our presenters here.
So 25 seconds, just because I have the prerogative to do this again. Thank you all very much for being here today. We hope you all come back tomorrow. The housekeeping is that 9 o'clock tomorrow we will start. Look forward to seeing everybody. Don't let the cold deter you. The second announcement, the posters I think will be up for a while, so look at them, and if you like what you read, bother the co-authors. They are all around here. Continue those conversations going. I saw lots of great talk during the longer break. And the third announcement, which is probably a statement against self-interest, is for those people that are writing papers on consumer financial issues, the deadline for John Lynch's conference in Boulder is tonight to submit abstracts for next May's conference. I just happened to get that email this morning. So if you if you have not sent your abstract out, you should probably do that because it's a wonderful conference and lots of great papers. And with that, let me thank both this panel and the previous one, and we look forward to seeing you all tomorrow morning. Thanks a lot.